This is Andrew Stotz of A Stotz Investment Research talking about world-class benchmarking. The company I'm going to talk about is Fraser Neave Holdings, Malaysia. So let's look at this. First of all, this is the way I look at a company when I'm trying to get a background on what it's doing. So we start looking at the upper right-hand corner of this company, specifically the background. Now, Fraser Neave Holdings was established in 1883, so it's one of the oldest companies in Malaysia and one of the oldest listed companies in Asia. Its main businesses are the manufacture and sale of soft drinks and dairy products, and it is second largest in Malaysia in terms of market share. In the realm of isotonic sports drinks, the company has an overwhelming 85% market share. If we look at the market capitalization, this company is about $2.2 billion US with a free float of about 23%. The beta of this company, very rarely do you find a beta of negative 0.2, but let's say that the relationship to the market is not particularly strong. Now, if we look at the upper right, I'm going to tell you a little bit about this company and what's going on. So F&H is number 2 beverage firm in Malaysia by market share. It enjoys 27% market share of the ready-to-drink segment. Soft drinks account for slightly more than a third of total revenue, and dairy products for nearly 2/3. It has 4 power brands: Oishi Green Tea, Est Cola 100 Plus, and Nutrasoy, a soy drink. Most of those actually originated in Thailand. All have top market share in Malaysia, and F&H has been successfully teaming up with other ASEAN beverage companies to market these brands throughout the region via licensing and other manufacturing and marketing agreements. Now, last year, the company's Malaysian license ended for Red Bull, massive product, but Ranger, F&H's own energy drink, looks set to replace it after F&H launched an aggressive ad campaign showing a Ranger drinking man able to scare off a bull accidentally dusted with red powder. So, dairy products include condensed and homogenized milk, are sold in F&H in Malaysia and Thailand, and it buys forward only 6 months of its inventory for the milk powder used in its processed milk products. So the global glut in raw materials is helping steady profit margins. So let's take a look at the breakdown of revenue. First, we can see dairy, 63%, soft drinks, 37%. We can also see 57% of revenue for dairy comes from Thailand versus 43% from Malaysia. So now let's move into the world-class benchmarking measure. So remember that I look at profitable growth and I look at 5 years, 2012, 13, 14, 15, and the past 12 months. What we can see is this company has maintained its number 2 ranking and has been stable in the top 3 deciles. This means F&H ranks better than 472 of 590 large consumer staples companies global, across the world. That's why we call it world-class benchmarking. So where is this profitable growth coming from? Well, profitability is number 1 rank. I look at ROA among the best, meaning it's among the best 59 large consumer staple companies in the world. And growth has been improving up to 3 from 6. Now, where is this coming from? Well, we can see that profit margin has increased from 3 to 2, and that's what's driving profitability. And if we look at growth, in this case, sales growth has been steady at about a ranking of 5 when compared to 590 other large consumer staple companies worldwide. But it's this margin change that's been improving as margins have risen. Now, do you want to see the profitable growth rank for a company in your portfolio? Well, leave a comment below with the company name and country of listing, and I'll do my best to post it if I have it.